Well, I'm very fortunate to be joined by three panellists who bring a wealth of experience to this topic, and I'm sure are familiar faces to many of you out there. I will start from my immediate right. Silvia Bosoni. Silvia is head of Italy ETFs, ETPs and open-end funds listing and market development for Borsa Italiana, part of the London Stock Exchange Group. She's been at the exchange for 2 decades and has been responsible for ETFs for more than 10 years. To her right, we have Slawomir Rzeszotko. Slawomir is head of institutional sales and trading for Europe at Jane Street. Slav has worked in the ETF industry for nearly a decade, including as Vanguard's head of ETF capital markets and at BGI and BlackRock in various ETF-related roles. And to his right, we have Thomas Merz. Thomas is Vanguard's head of distribution ex-UK. Thomas is responsible for expanding Vanguard's presence in both new and established markets in Europe. And before joining the firm in 2017, he was responsible for UBS's European ETF business. Thank you all for being here.
Thank you.
Now, as I promised or perhaps threatened, this is going to be an interactive event. So I want to kick off the conversation with another poll. So the question we're looking for help answering is, what factor will drive the most asset growth in ETFs over the next 5 years? Which factor will drive the most asset growth in ETF assets over the next 5 years? So the three answers we have for you to chime in on are innovative strategies, a focus on cost, or regulation. So is it going to be innovation, cost, or regulation? So please cast your votes now. The question we're looking for help answering is, which factor will drive the most asset growth in ETF assets over the next 5 years? I think we're seeing whether we can kind of get the results coming through. We may have to come back to it in a moment as we're being told who our wonderful sponsor is at the moment. All right, we'll come back to that in a second. But I think it will provide an interesting jumping off point for our conversation when we do have those results. As we have been seeing kind of more and more kind of products coming to market, over 2,800 products out there at the moment, which is significantly more than the US, which I know surprises an awful lot of folk over there. So I kind of wanted to come to you, Thomas, first, to pick up on a point that Sean made. Is all this proliferation a good thing for the investor, do you think?
Yeah, I think it's not a simple answer here. I do think there are reasons why, for example, there are more products in Europe than in the US. As we all know, this market, not only the ETF market, but the wealth market, the market for investors to choose for their building blocks is more fragmented, is more colored by maybe some regional preferences, which makes it inevitably to have a bigger variety of products. So it doesn't surprise me. But yes, coming back to the question, do I think it's only a good thing, or is there really something in there where we have to be cautious? I do think I agree with Sean. There can be problematic, because I think in some ways it perverts a bit the indexing thought if you slice and dice a exposure very narrowly. And not only because there might be not a liquid basket behind, but also indexing is for taking the broad beta and reducing idiosyncratic risk. And if you slice and dice the market so thinly, you pervert that thought. So I do think we have an issue. We also have an issue, I think, with that variety of products will inhibit some producers to lower costs and gain scale effect. And I think that's also a thought we have. We're of the opinion that we want to have a couple of products which hopefully become very large so we can give back that scale to investors and lower OCFs, lower costs. And that includes how you maintain them, where you list them, how many changes you have to do, maintain prospectuses. That all adds to cost. And I think that's another angle we are very convinced that having a condensed, meaningful, simple range of products for investors is a good thing.
Well, that brings us back to our poll where we've got some results now. So you can see that the focus on cost is going to drive the most asset growth for more than a half of people responding. Excuse me. But innovation is still looking there as something that a third of folk that have been responding think will actually drive asset growth. So Silvia, I want to come to you on that. Obviously, you're sitting at the Borsa Italiana, you see a lot of these products coming to market. What do you see innovation in?
Okay. Drink, I don't want
I'll be fine.
Okay. Back to the topic of numbers of ETFs, I was just thinking that we have now reached the 1,000 ETF listed, and I was so proud of it. Yeah, now I'm a bit guilty, I feel a bit guilty, but no, actually what is good in Italy is that since that's not the good part, we don't have any Italian providers. What is happening is that every provider, ETF providers, comes to Italy to propose ETFs that they believe will work. So actually, I believe there is a how can I say, check if this product can be useful for the market. Of course, there will be a check, ongoing checks, and if it's not the good product, the right product, they can be replaced by others. So we are starting to see some delisting that at the very beginning we were worried about. Now it's this place to keep and maintain efficient the proposal, the shelves with all the products we have. Back to, sorry.
No, I just wanted to add one little stats just to explain that. If you look at the global but also European distribution of where assets actually sit, which products, to your point, right, the market will tell us which products have actually a raison d'être, are, here to stay. About 11% of the products are actually decent in size of those long tail of products. So I just want to say there's statistics over now years and years that I think only a handful, 10, 20% of the products are actually have a reason to be used, right? And I think that will also correct some of those developments.
That's a good reason. And I wonder, Slav, sort of chiming in on that from a trading perspective, is there a limit to the types of exposure that we can actually put into an ETF and that will trade effectively, or is the sky the limit from your perspective?
I think certainly there is a limit, and I think we certainly have been spending more and more time with ETF issuers working on the innovation ideas, discussing how those investment themes will look like from a long-term liquidity provision perspective. I don't think we are quite at the limit. I think by and large the proliferation that has been discussed here is not necessarily a proliferation of very exotic themes yet. It's more, I think, proliferation in terms of addressing some of the things that Thomas mentioned. So preferences that are very specific regionally, and also like numbers of listings tend to grow because of different currencies, different share classes. So optically, I think this universe might look more daunting in Europe than it in fact is, just because of how Europe is in terms of having all those differences. Very simple example, Italy is a very big fixed income market. We see a lot of fixed income ETFs being traded here, being very popular here. There are some markets across EMEA where we trade very little in fixed income ETFs, right? So there are just going to be those local flavors. Long term, certainly, I think we do share some of those concerns that at the end of the day, ETFs are just wrapper products for some underlying asset class, right? So you're not going to, in the short periods of time, when markets are favorable, one of the nice things about ETFs is that you can benefit from cheaper cost of liquidity accessing it via ETF. But it's not something that can be responsibly promised as a given to investors across every asset class and across every ETF, and that should be very clear.
Silvia, I want to come to you on that because when we spoke in preparation for this panel, you mentioned kind of the fixed income aspect of ETFs being very important in Italy. What does the landscape look like in terms of those types of products?
Yeah, the last snapshot, end of May, sees that health, actually 48% of AUM in Italy in ETFs is composed by fixed income ETFs, and that's huge. I was looking back to old statistics. 5 years ago, we were about, it was 37%. So it's an increasing, so nice. It's an increasing, is a trend that is increasing, stable increasing. and it's also driving the inflows. Of course, these flows are institutional flows, definitely. In back 2017, the 60% of the inflows were in fixed income. Last year, 70%.
Wow.
And year to date, this year, we have already gathered 3.5 billion. So it's definitely...
So what is it that drives the flows so much into fixed income products in Italy?
I believe as he was saying, the expertise and the know-how that Italian investors have in the fixed income space. Of course, we started with the Italian govies long ago, and there is this know-how. And the interesting thing is that in this case, investors are not only using direct underlying, so directly govies, but going through the ETF because they are perceiving that it's efficient and low cost, and it also make easier to assess some, can I say, fixed income spaces that were not so easy to assess before ETFs, the govies, emerging govies in local currency, these kind of things were a bit, can I say, a nightmare at the beginning.
I just wanted to add one thing which probably Slawomir also can add. I think in that space, the fixed income, which is traditionally not an index space, came later to the indexing world, and B, came later to the ETF world, as just we heard, right? The stats were 1%, 2%, 10%. Now it's net cash flow 70, 50%. It depends on the year, right? Is actually that in that field, ETFs could really showcase one of their benefits. It's making that basket trade, which is an ETF wrapped instrument, so easy, right? Convenient. And in some instances, in particular when it's kind of a normal market condition, you could trade an ETF tighter than if you had to go really directly. And I think being Italy such a fixed income oriented single bond place, I think they really discovered, hey, ETF is actually for me quite an easy access way into this market I'm anyway exposed greatly to. I think that's where ETFs really showed the benefit to the world, and I think they're really on a catch-up road at the moment.
Yeah, Slav, do you want to weigh in on that? Because, I mean, fixed income, obviously it's harder to trade, but ETFs do provide that kind of way to get different liquidity and different exposure in a very tradable form.
I think it's one of the most fascinating aspects of the continuing growth of ETFs. What this means for the fixed income market. If you just take a step back, and it's pretty obvious that suddenly you have a listed instrument that gives you access to an otherwise over-the-counter asset class, which is huge from the perspective of price discovery and transparency and ability to understand the valuations of this market, but can also be extremely powerful from the perspective of accessing this liquidity and saving both cost in terms of trading in certain times and at certain exposures, but also just pure time. So, often I think a question would be, well, maybe my investment activity is focusing around active strategies. Why would I need to look at ETFs? In particular, when it comes to fixed income, when maybe this is still, as Thomas said, a little bit newer to think about indexing. But in fact, when I look at the client base that we interact with, and when I look at applications of fixed income ETFs, I think what is now happening is a change driven predominantly, or to a large extent at least, by active fixed income portfolio managers who are benefiting from ETFs in this space as a source of liquidity, as a price discovery tool, and as another tool in the toolkit that allows them to get the exposures that they need in a different way.
That's very interesting. And Silvia, I mean, how do you see kind of institutions in terms of their comfort level with these products? Are they more comfortable, say, today than they were perhaps 5 years ago? Slav mentioned kind of active managers using these. Like, what do you kind of see from your side?
Our perception, of course, as we are, can I say, fixed income based, we were also perceived as retail based. The Italian market has this strong participation of retails. Actually, and this made us the first exchange in Europe for a number of trades for a very long time. Now how can I say, institutional investors are more keen on investing in ETFs, and we see it in the market. Turnover is increasing, and in comparison with the other exchanges, the last official European statistics shows that we have been second in Europe for turnover since the beginning, so year to date, since the beginning of this year. And this is a great achievement for us. We were third last year, and before we were fourth. So it's something is definitely changing in Italy.
That's interesting. So getting kind of like more institutional trading in that space rather than just the retail market. Thomas, I want to come to you on that, because obviously a lot of Vanguard products are designed very much to be long-term holdings, more buy and hold. How has that conversation been evolving with getting investors interested in actually buying ETFs for the long term?
I think, partially this development we just discussed of, hey, fixed income becoming really more a portfolio tool of choice is also due to what we see across Europe, that ETFs in general have now kind of been accepted in the classical wealth management balanced portfolio. And what's in there, right? It's equities and bonds. And mainly it's used traditionally mutual funds, active mutual funds, and that has kind of shifted also towards ETFs. So ETFs are these days across Europe part, not fully, but part used in those portfolios, which actually have driven the demand for those instruments. And on both sides, on the equity side, but also on the fixed income side. So I think it's partially, yes, institutionals, and by the way, also very, very large institutions are using these days fixed income ETFs, like central banks who have never used ETFs at all have now started using ETFs, but in a different way than the wealth portfolios, which are just constructing well-balanced, simple 60-40 or a bit model portfolios with building blocks, right? So I think it's really the broadness of the usage of ETFs have really kind of driven those demands and those behaviors, right? I think you see it also on the trading side, where 10 years ago it was like a very professional market, using block trades, OTC, NAV, at-risk trades. What worries me though a bit, or concerns me a bit, is we haven't yet achieved that the exchange-traded fund is actually an exchange-traded fund. It is somehow, through certain developments, still very OTC, RFQ-driven market, right? And if you compare that really to the US, where it's mainly an on-screen market, it is still kind of, traded, executed through big bulks of money. That, I think, referring to a point Sean was making, is I think we are just in front of that tipping point when really fee-based advisory into retail clients, their model portfolios, then this execution might go more on exchange than just OTC, which I think is still kind of a bit of a block of understanding liquidity, of seeing, hey, these instruments are actually easy to trade, because it's less visible.
That's a good point. I want to move on to the trading now, and Slav, I want to bring you in on that. Like, what do you make of kind of the price transparency, the liquidity of markets now? Like, there was an awful lot of talk about MiFID II, which I'm sure will pepper our conversation on that, and how that was going to be transformational. But what do you see of the landscape now when you're trading?
So a few very interesting points here, and if I may start, I would want to go back to the polling results where cost came on top, and I think it's important to note that it is the overall cost. And when Thomas says that, like, there's more investors that are now looking at buy and hold strategies utilizing ETFs, I think it's a testament to the fact that this overall cost, including the trading cost, has come down. And it has come down partly because investors started to think about ETFs as an instrument on its own when it comes to trading it, right? Like, so in the early days, it was just like it's an equity-like product or it's a fund. So either somebody traded as a fund or they traded as an equity-like product. But that is not extracting the maximum possibility to minimize the cost. Now, there's a lot more infrastructure, there's different ways of accessing this liquidity through, say, RFQ platforms. There's also a lot of infrastructure built by exchanges in terms of supporting the transparency of liquidity, and by issuers with running very sophisticated capital markets teams. What Thomas says, I think, is very true in a sense that I would sort of separate the liquidity conversation into two parts. One is the ability to understand liquidity that exists in ETFs, and the other one is the actual process of interacting with that liquidity. I think we see a certain dichotomy at the moment where sophisticated and experienced users of ETFs are actually doing pretty well, able to access liquidity at a good cost, because they are combining different strategies. They are utilizing liquidity that they see on exchanges. They can go into the over-the-counter market. They have sophisticated ways of accessing request for quote platforms. So all in all, I think they're doing well. Where there's certainly still work to be done, this hasn't been fully addressed by MiFID II, is the ability to understand the liquidity, particularly for those who are looking to enter the ETF market, right? Like on average, say, you probably have to look at 70 different Bloomberg tickers to actually understand the liquidity of a single fund at the moment. There's a lot of tickers, right?
Yeah.
Like people whose life and professional career depend on this, like sad individuals like myself, maybe do that. But day to day, investors have many things to do. So this does not create this transparency picture. Okay, all the trades need to be trade reported, similarly like it's in the US. But just the visibility of what happens with that trade reported data is just still not there. And I think that's still one of the main problems.
Silvia, what are the exchanges doing to kind of facilitate this, to help out traders like Slav and others that don't want to look at kind of 70 tickers and have to try and process all of that information to understand liquidity? What sort of tools are out there to help with trading?
What we have added to the trading platform is recently the opening auction, to have the same platform that all the other exchange has, because at this very moment, the more peculiar you are, the harder is to understand you. So if we can have the same setup, it is better. The closing auction that we introduced some times ago for some institutional investors, like insurance, they need to trade at a price that is the reference price, because they have to put it in their book, is growing, is more used by institutional investors, so that's working. And the main things that we have done a couple of years ago, we've introduced the RFQ. That is a bit strange for an exchange, but what we wanted to do is at the very beginning is working well. I mean, this year we have already exchanged 5 billion, so it's working. We have 10 market makers, 10 requesters, so it's starting definitely. Now, don't know if I can spoil it, but we are working at the next step, and the next step will be an interaction with the RFQ with the book. That's in our perspective is something that will add liquidity in both environments, and capturing OTCs flows, traditional OTCs flows through the RFQ will allow us to take also these flows to the market, to the lit book, sorry, if the book is worth having these flows. So if market maker, liquidity providers, all these the capital market teams of issuers will focus on providing liquidity also on screen. So everything will, but I cannot spoil any further because I have my colleague from the. Okay, so we will.
For me, the question just would be, how do we help investors, self-directed or intermediate through financial advisors, to actually access this liquidity? Showing is one thing, but how it's actually accessed. And I think you made a point. This will trigger, a true accessibility through this liquidity, through connecting different platforms. I'm not talking about the stock exchange. I'm talking about different platforms then getting this liquidity kind of accessible and making it accessible for everyday normal investors. I think that's where we try to move the dial a bit and make sure that this liquidity for this instrument can really, be beneficial for all investors, not only the big ones who know, to your point, who know exactly how to trade, who to phone up to get the best price. But I think that's where we're still lacking, and I think that's where also the stock exchange have some play to do.
One way comment to make, I think it's important also to keep things in perspective in a broader market sense in what's happening in Europe. And if you look at just broad equities trading, like for those of us who are not day-to-day engaged in equities market, this may be not so trivial, but for others it's probably very trivial. But a lot of equities trading in Europe is not happening in lit, right? Like there's a plethora of solutions where institutional clients trade equities outside of lit exchanges. So I'm saying this not because I'm saying it's good or bad. I'm just saying that we shouldn't necessarily think that something is uniquely broken about ETF liquidity. I think this is something that goes across the equities market, and ETFs trading like equities experience some of those same characteristics, and there's some unique features as well, obviously related to the fact that ETFs are also open-ended funds and are different.
What would be the game changer for you then?
From our perspective, fragmentation of listings isn't what we need. Like from our perspective, we would ideally want to work with one consolidated order book where we can provide liquidity into one central place. But of course, this poses a lot of issues from the distribution perspective. So a lot of conversations we usually are having with issuers is like, how do we strike some middle ground here, how they think about the listing strategy so that there actually is going to be a meaningful interest in this as compared to just ticking some boxes and creating another listing that takes liquidity away, because, for instance, we have to spend resource in terms of technology and capital providing those markets on each and every listing.
That is always the challenge, isn't it? Getting something that's not a tick box response back to things. Well, I think that's pretty much all we've got time for. So thank you very much to my wonderful panellists for such an interesting conversation. Please join me in giving them a round of applause.